Assalamualaikum and hi everyone. So today we will be presenting our solutions for the FIN 549 February 2025 past year examination paper. Our presentation consists of questions 1 to question 5. I will begin by presenting question 1. Question 1 focuses on FCPO futures trading, where we are required to calculate the daily variation gains and losses, determine the overall profit or loss from a futures position, and discuss the requirements of a viable futures market. Next, we go to question 1A part 1. In this scenario, Mr. Lee anticipates a downtrend in the price of crude palm oil CPO. Since he expects the futures price to decrease, he takes a short position, which means he sells the futures contract first and plan to close out the position later by buying it back at a lower price. The spot price is Rm 4,325 while the futures price is Rm 4,334. Mr. Lee trades 6 FCPO contracts. The initial margin is Rm 4,500 per contract. Therefore, the total initial margin is calculated as Rm 8,500 times 6, which equal to Rm 51,000. The maintenance margin is Rm 6,500 per contract. Therefore, the total maintenance margin is Rm 39,000. Next, I calculate the daily variation gains and losses based on the changes in the futures closing prices. On 19 February, the future price decreases from Rm 4,334 to Rm 4,330. Since Mr. Lee holds a short position, he records a variation gain of Rm 600. On 20 February, the futures price decreases further to Rm 4,320, resulting in another variation gain of Rm 1,500. On 21 February, the futures price increases to Rm 4,325 ringgit, so he records a variation loss of Rm 750. On 22 February, the futures price increases again to Rm 4,332, resulting in another variation loss of Rm 1,050. On 23rd February, the future price decreased to Rm 4,325, so he records another variation gain of Rm 1,050. Finally, Mr. Lee closes out his futures position on 23 February. The total profit is calculated using the difference between the initial future price and the closing future price. Rm 4,334 minus Rm 4,325 times 6 and times 25. It will equal to 1,350. Therefore, Mr. Lee earns a total profit of 1,350 because the future price closes lower than the initial future price. Okay, next we go to question 1A part 2. For part 2, the futures price closes at Rm 4,338 instead. Since the closing futures price is higher than the initial futures price of Rm 4,334, Mr. Lee incurs a loss because he has a short position. The calculation is Rm 4,334 minus Rm 4,338 times 6 and times 25 equals to negative Rm 600. Therefore, Mr. Lee incurs a total loss of Rm 600. For question 1B, now I will explain the 3 requirements of a viable futures market. First, requirement is a deep market. A deep market means there are many active buyers and sellers in the futures market. This makes it easier to buy and sell futures contracts without causing significant price changes, allowing the market to operate more efficiently. The second requirement is easy grading. Since crude palm oil is an agricultural commodity, its quality must be classified using standard grades. This ensures that buyers and sellers have a clear understanding of the product quality, making trading fair and efficient. The third requirement is free price fluctuation. This means futures prices should be determined by market demand and supply without excessive government intervention or monopoly. As a result, the futures market can reflect the true market value of crude palm oil.
Next, I will present question 2A, which is about identifying and executing an arbitrage opportunity between the CLIBOR futures market and the physical CLIBOR market. First, let's look at the information given. The March CLIBOR futures price is 95.6%, which implies a futures interest rate of 4.4% because the futures price is calculated as 100 minus the interest rate. We are also given the 60-day CLIBOR rate of 3.5%, the 150 days CLIBOR rate of 4.5%, and the dealer can borrow and lend 5 million ringgit. The first step is to calculate the implied forward rate of, or known as IFR. We use the 60-day and 150-day CLIBOR rates to estimate the implied interest rate of the remaining 90-day period. After substituting the values into the forward rate formula, we obtain an IFR of approximately 5.14%. Next, we calculate the fair value of the futures contract. The formula is simplified. Fair value equal to 100 and minus the IFR. So the fair value is 100 minus 5.14%, which equals to 94.86. Then we compare this fair value with the actual futures price. The market futures price is 95.6%, while the fair value is only 94.86%. The dealer can borrow and lend a total of 5 million ringgit, and since each CLIBOR futures contract has a notional value of 1 million ringgit, the dealer needs to trade 5 futures contracts. To carry out the arbitrage, the dealer should first borrow 5 million ringgit for 60 days at 3.5%. At the same time, the dealer lends 5 million ringgit for 150 days at 4.5% to earn a higher return. In the futures market, because the futures contract is overpriced, the dealer should sell 5 March CLIBOR futures contracts at the current price of 95.6. After 60 days, the borrowing is repaid and the dealer rolls over the borrowing for another 90 days at the prevailing forward rate. At the same time, the futures contract reaches maturity and the dealer closes the short futures position by buying back the contracts at the fair value of 94.86. Now, let's look at the profit calculation. From the futures transaction, the dealer earns a profit because the contracts were sold at 95.6 and bought back at 94.86, resulting in a futures gain of 9,250 ringgit. The dealer also earns 93,750 ringgit from lending 5 million ringgit for 150 days. However, the dealer must pay interest on the borrowings, which includes 29,166 and 67 cents for the initial 60-day loan and 55,320.83 cents for the 90-day rollover loan. In conclusion, because the futures price was higher than its fair value, the dealer successfully exploited the price difference through arbitrage and generated a risk-free profit of around 18,512.50 cents. For question 2b, a corporate borrower can use interest rate futures contracts on Bursa Malaysia derivatives to hedge against rising interest rates. Before taking a loan, the company sells future contracts. If interest rates increase, the futures position generates a profit which helps offset the higher borrowing costs. Although the loan becomes more expensive, the gain from the futures contract reduces the overall financing costs. Therefore, this strategy protects the company from interest rate fluctuations and provides greater certainty in financial planning and cash flow management.
So, I will continue question number 3. Before I starting the calculations, I identify that this is a hedging question, the keyword of fund manager, and also expect a downward correction.
These keywords show that the fund manager already owns a stock portfolio and wants to protect it from a possible decline in the market. Therefore, the appropriate derivative product used in this equation is the FTSE Bursa Malaysia KLCI Futures or FKLI. So, for question number 1, step 1 is I calculate the number of future contract required using the H ratio formula. So, the formula is amount to H times percentage of H times beta divided by value of contract. So, in this equation, the portfolio value is RM 10.5 million, the portfolio beta is 1.5, the futures price is 1625, and the contract multiplier is RM 50. After substituting this value into the formula, I obtain approximately 193 futures contracts. Since the fund manager expects a downward correction in the market, the appropriate strategy is to take a short position in FKLI futures. Step number 2 is outline strategy, which is today, in cash position, the fund manager owns a stock portfolio worth RM 10.5 million. At the same time, the market index is 1620 and the expectation is that the market will decline. Therefore, in future position, the fund manager opens a short hedge by selling 193 FKLI contracts at 1625. Next is later, which is the after 90 days. In cash position, market's outcome is different from the expectation. The FBM KLCI increased to 1640 instead of falling. The hedge, the fund manager buys back the 193 FKLI contracts at 1640. This is known as the offsetting position, which is at futures position. Because the futures were sold at 1625 and bought back at 1640, the futures position records a loss. Question number 2, which is required to calculate the value of the hedge portfolio after 90 days. Firstly, I calculate the futures position. Since the fund manager expects a downward correction, the appropriate strategy was to take a short position in FKLI futures. The futures price increased from 1625 to 1640 at maturity. Because sold the futures contract at a lower price and bought it back at a higher price, the futures position recorded a loss. The calculation is the selling price minus the buying price multiplied by the number of contracts and the contract multiplier of RM50. Therefore, the future position is a loss of RM 144750. At number 2, I calculate the cash position. The cash position measures the change in the value of the stock portfolio. The market index increased from 1620 to 1640, resulting in a positive market return. So, the formula for calculate the cash position is ending index minus beginning index divide beginning index time amount of H time beta. So as a result, the cash position gain RM 194444. Step number 3, I calculate the net effect by combining the cash position and the future position. So the cash position gain RM 194444 while the future position lost RM 144750. So to calculate the net effect, I use the formula, which is the future position plus with the cash position. Therefore, the net effect after hedging is a gain of RM 49694. Step number 4, I compare the portfolio value without hedging and with hedging. For without hedging, I use formula total value of hedge plus cash position divided by NOC times 50 ringgit. And for with hedging, I use formula total value of hedge plus net effect divided by NOC times 50 ringgit. So, for the portfolio without hedging, the cash position gain is add to the initial portfolio value. This shows the portfolio performance if no hedging strategy had been implemented. For the portfolio with hedging, the net effect, which includes both the cash position and the future position, is add to the initial portfolio value. This represents the portfolio performance after applying the hedging strategy. And the last question, Bursa Malaysia Derivative Berhad play an important role in supporting fund managers and manage stock price volatility. Firstly, it provides FKLI, which allows fund managers to hedge against market declines. Secondly, it offers options contract to provide greater flexibility in managing investment risk. Thirdly, it improves price discovery by reflecting market expectation. Fourthly, it enhances market liquidity, allowing efficient trading with lower transaction costs. Next is it reduces counterparty risk through its central clearing system. And the last one is this derivative product help fund managers manage portfolio risk and achieve more stable investment performance.
Assalamualaikum warahmatullahi wabarakatuh, and my name is Muhammad Daniel Shukri bin Kasmin, and today I will help you to answer question 4. Given the question, Hassan, a trader, is bearish on the current 5-year MGS futures FMG5 market and aims to capitalize on this situation. The available quotation for the FMG5 on February 9, 2025 are as follows. Firstly, March 20 FMG5 contract at 104.23 and at June FMG5 contract at 104.16. Firstly, we need to explain the outline and we need to know what there is in the question. So firstly, we know that Hassan is a trader, and then we know that March FMG5 is at index level, index point 104.23, and June FMG5 is at 104.16, and then we know that it bearish on 5-year MG5 contract futures market, so the price is expected to decline. So our today is 9 February 2025 and our later is 6 March 2025 on the first question. Alright, and then for the type of spread, we need to use this type of spread is bull spread, so we need to execute based on the question. We need to execute bull calendar spread where we need to sell June FMG5 and buy March FMG5. The constructed table here shown that we need to sell by 6 contract of March FMG5 at 104.23 index point, and then we need to sell 6 June FMG5 at 104.16. okay, and then we see that the later in 6 March we need to sell back the 6 contract that we buy for March FMG5, and then need to buy the 6 June that we sell on the 9 February. So at cash position, we have sell price and buy price, so we need to sell price first minus the buy price, and then times the index point and times the NOC, the number of contract. So you can see here the calculated position that we in the cash position we have lost a total amount of 3,420 ringgits. Second, we need to calculate the futures position, where here I have shown you where we have a profit amounted at 4,000 ringgit, 4,470 ringgit here profit. And then lastly, we need to see when there is profit or not. So firstly, we need to take the futures position and we need to minus the cash position, and then as you can see here, and we gain 1,320 ringgit in total. So now let's discuss about what are the importance of MGS futures in the long-term market. First, MGS futures will allow investors and financial institutions to protect themselves against adverse movement in interest rates and bond price. Secondly, the futures market helps to determine the expected future value of Malaysian government securities. MGS providing valuable information to market Participating in MJS futures increase the liquidity of the long-term debt market by attracting more participants and facilitating easier buying and selling of government securities. Lastly, fund managers and institutional managers use MJS futures to adjust the duration or the risk exposure of their bond portfolios efficiently. So that's all for me. Let's go next to the question 5.
Let's dive straight into the question 5A. In this scenario, our investor expect ABC company stock price to decline. To profit from this drop while minimizing potential losses, the investor set up a bear put spread. To do this, the investor buy a higher strike put option at RM50 for a RM3 premium. At the same time, they set a lower strike put option at RM45 and receive a RM1 premium. Because they pay RM3 but get RM1 back, the net cost to set up this trade is exactly at RM2. Looking at the diagram, if the stock stays above the RM50, the investor lost RM2. If it drops below the RM48, they start making money, keeping out at the maximum profit of RM3 at the RM45. For payoff table at RM40 and RM45, both options are active. The gains from long put perfectly balance out the losses from the short put, giving us the maximum profit of RM3. At RM48, long put makes RM2, which exactly covers the net cost. This leaves the zero profit, proving the RM48 is the break-even point. At RM49, there are small net loss of RM1. At RM50 and RM56, both options are expired. The investor just lost the upfront cost, resulting in the maximum loss of RM2. As we look at the graph, it is still capped at RM2. However, notice that the break-even point is now at RM42. This means that the stock has to drop much further from the single option to start making money compared to the spread strategy, which broke even earlier at RM48. To finish up, let's answer part B about the bear put spread limit both risk and reward compared to a simple put options. A bear put spread is created by buying a higher strike put and selling a lower strike put with the set expiration date. Selling a lower strike could reduce the net premium, making the strategy cheaper than buying a single put. Next, the strategy has limited risk and limited profit with a lower maximum loss than a long put. Lastly, it is the best for a moderately bearish market as profit is capped once the stock price falls below the lower strike price.